Welcome back to the Old Fashioned Real Estate Show with that.
Brian Leverage.
And I'm Jeff Hulse. And today we're going to talk about 3 reasons you should always put money in your deals and 1 reason you never should.
Looks like you just gave the finger to the camera.
This is the index finger. And we're going to talk about those right after this. But be sure you stick around for that last one, why you should never put money in your deals. Because it's really important.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Hulse pour out old fashioned real estate advice.
Okay, so 3 reasons why you should always put money in your deals. Reason number 1 is optics. It looks good. I mean, and I know that sounds kind of crazy, but if you're raising money for a deal, so say you're doing a syndication or you're just asking partners to join you on a deal, you should kind of believe in the deal. And if you believe in the deal, people are going to be like, why aren't you putting money in? So even if it's a relatively small amount of money, maybe you don't have a tremendous amount of capital, putting a little bit of your own money in shows good faith.
100%. And that's, investors, the real estate investment itself, if we're talking syndications, or even not a syndication, one where you're doing it with, say, close friends or family, etc. It's the real estate is just the vehicle by which they're really investing in you. They're operating on their faith in you to accomplish this and see it.
It's definitely true in a syndication, right?
Yeah.
Because they're not even investing in real estate; they're buying shares in a company that you manage.
Right.
So they're really investing in you.
Exactly.
And
you know what they say about pro formas.
Yeah.
So.
And they always work.
Yes.
but above us here is a video we did on syndications and what syndications are. So if you're not familiar with that term, just watch that video. Yeah. But the short version is it's where you're pooling a bunch of investors' resources together, and there's a small group of individuals that manage the deal. They typically get a piece of the deal for running the deal, finding the deal, and things like that.
Yeah.
If you're doing that, you're raising money, and you're make sure you're complying with the laws and all that. But if you're doing those things, putting some of your own money in is a very brilliant sales pitch. I mean, I once sat through a presentation, a webinar, where I almost invested, even though I thought it was a bad deal, because the guy said at the end, and just so you know, I'm personally putting $500,000 of my own money in this deal. And I was like, whoa, I need to reevaluate. Maybe I like this deal more than I thought, because if somebody's willing to put $500,000 of their own money in on the same terms that I'm getting, then I'm thinking
more
maybe there's something
Yeah.
there. And as a general rule, I personally like to invest in deals where people believe in their deals.
Yeah.
I think that's a smart thing. And one metric for whether they believe in it is if they're putting their own capital.
Yeah.
So the second reason to always invest in your own deals is
Compounding.
That's right. If it's a good deal, why wouldn't you put your money in it? I mean, if you have capital and you put it into a deal and you get a return on that capital, it's a win.
Well, and it also comes down to how the deal is structured, right? In our case, the way most of them are done, really all of them, is the investors get their capital back first, right? The LPs before the sponsors, and then there's a split after that, right? So once you as an investor have gotten your original equity back, you're almost on a free ride at that point, right? And it's just
right.
Those returns.
And frankly, if you're doing right by your investors and giving them an opportunity to make an investment that makes sense financially for them, probably makes sense for you.
Well, yeah.
Right? So if you're sitting on $100,000 in the bank account and you have an opportunity to deploy that into something that does better than the interest you're getting on CDs, gives you some upside, why wouldn't you do that?
Well, I mean, in case in point, we had a couple deals we closed out a few years ago at this point, but they were, I think, for the investors, right around a 30% IRR. Why wouldn't I want to make that myself?
Right. Yeah, I mean, and it's cool, on the carried interest portion that you make essentially an infinite return, but putting your own money in makes sense if it's a good investment, and if it's not a good investment, you shouldn't be raising money for it.
Right.
So if you believe in the deal, like the first point, that's why you put your money in, to prove you believe in it. But if you actually do believe in it, and you have money, you should put it
Yeah.
in the deal because it's a good use of your resources.
Exactly. That takes us to our third point.
Wait, are we at the third point already?
Yeah.
Maybe we should have had 5. All right, what is the third point, Brian?
Well, I was pitching it to you.
Cheers.
Yeah.
And that's the old-fashioned real estate show. Because we're not really sure. No. So, all kidding aside, there are actually a myriad of reasons why you should invest. You know, obviously the first one we covered was, you know, just because it looks good optically. The second one is that it's a good investment.
Well, a third, I'll even throw this out, is diversification. If you're doing different assets, right? Like maybe you've got apartments, maybe you've got some commercial. We did another episode where we talked about condo conversions, etc. You know, those are all diversification within real estate investing.
But of course, in fairness, you're already diversified if you're the carried interest.
True. But you're just doing the same with your capital. Right.
And that wasn't our third one, though. We actually did have a third one pre-planned.
Now,
you're just
fourth.
3.5. No, diversification is a legitimate point. But really the real reason that you should put money into your deals, the real reason is, I'm just putting you on the spot here to see if you remember what we came up with earlier.
Besides diversification. And optics.
Yes.
And compounding.
Right, correct. Besides all those.
It's more.
Okay, so the real third one, Brian, is now that you stopped distracting me with diversification, the real third one is that it actually makes the deal safer, right? When you deploy your own capital, you're taking some of the risk away from your investors, which I believe we have an ethical duty to do whenever possible, because when we're taking investor capital in, we have an obligation to protect that capital to the extent we can. So if we have an ability to reduce their risk by absorbing some additional risk on our own, we should do it. Now, there are other ways to do this. For example, the limited partners typically don't have to sign personal guarantees, and a lot of times as a general partner you do, so that's taking a bunch of the risk off the table by signing that personal guarantee. But we're being compensated for that risk by getting a carried interest. And so for me, I feel that I have an ethical obligation to put money in deals occasionally to bring the risk profile down, because then I'm risking some of my own capital, and therefore I'm also going to protect it more, right? Because that's the other thing. There's a psychological advantage to having your own capital at risk, right? If I put my own capital in, I'm paying more attention. Now, it shouldn't be that way, but it's just the reality. We want to protect our own capital. It's not that you and I aren't trying to protect investor capital, but psychologically, when we have some of our own money in, we're going to be like, I don't want to lose money. No, I don't want to lose anybody's money. And actually, there's a real argument that you should protect investor capital above your own, and that's another thing that putting capital into the deal does, is it forces you to protect the investor capital very, very much. So that is the 3 reasons why you should always put money in. So, but Brian, there's a 4th thing that we were going to cover today, and that was one reason you should never put money into your own deals. Okay, go ahead, Brian. What is that reason?
Opportunity cost.
That's
probably not.
That's not right. I mean, okay, so in fairness, when we started this video, we didn't actually have a reason why you should never put money in deals, because we do think you should put money in if you can, but there is actually a really good reason, and it is related to opportunity cost. And that is where if you put money into the deal, it's going to put you in a situation that's going to create financial hardship. We've often said you should never invest your last dollar in a real estate deal. And, you know, in the case of a syndication, which we've been talking about the majority of this episode, there's a capital reserve that's typically raised as well. So you have that safety net, but you also have to consider your personal financial situation. If you have to take money on a credit card cash advance to put money in your deal, then don't do that, right? Don't put yourself into a financial situation that's it's just not good, right? An untenable financial situation. And so the reason not to is you just can't afford it. And that's okay. You know, the very first syndication I did with you. At that time, I was a little bit strapped for cash. I didn't put any money in that deal. No, I did sign the personal guarantee, so I took the risk. I believed in the deal, and I disclosed that I didn't have money in the deal. Like people knew that I hadn't invested in it, and so there was nothing unethical about it. But in that case, if I had put money in, it would have put me in a financial situation that wouldn't have been good. So the reason not to invest in your own deals is because you can't afford it.
Right.
If you can afford it, for the reasons we outlined, you should do it.
Yeah. And it may be one of those things that is Jeff sort of just touched on. When you're starting out doing it, you may be in less of a position to do so than you will later on with time and experience under your belt and having closed out a few deals.
Yeah, and frankly, there are other reasons besides just you personally can't afford it. If a particular deal is filling up really fast and you have a position in, this happened to me on a deal a few years ago where I had actually put money in and it was sold out and somebody that really wanted in.
Yeah.
I said, well, all right, I'll take my money back. You can go ahead and have that position.
Same applies. I wanted to invest in another one and it subscribed so quickly
You
that
couldn't
I
actually
was
do
like,
it.
well, that kind of just sucks.
Right. I mean, and again, that's a good problem to have when the
Yes.
money's coming in quickly and we're able to do the deal without having to put our own cash in. But as a general rule, if you can put your cash in, you should.
Mhm.
And unless there's a reason not to, and the reasons not to are going to be like because there's no room or you can't afford it.
Yeah.
So
100%.
anyway, that is a summary of the 3 reasons that you should invest in every deal and 1 reason you never should, which isn't really true because it's only in those limited circumstances that you never should. And I'm Jeff Holst. That's Brian Leverage. This is the super popular Old Fashioned Real Estate Show, which you're going to like and subscribe to right now.